Yeah, we call it because it's the first public webinar I've done for a while. I'm recording it in Omnova itself and using Camtasia, so hopefully one of them will work. So yeah, it's being recorded, and I'll send a mail around when I haven't figured out how the means with which I'm going to upload it, because it will be obviously a lot bigger than the usual video. So the usual places I upload it to won't be. I won't be able to do it there. So once I figure that out, I will send a mail around when it's ready to be viewed online. Okay, so this is basically just a follow-up to the 5 videos that are on my website. So in those 5 videos, I've basically gone through the concepts and how I basically, well, the basics of how I trade false breakouts. So I'm just going to summarize some of the main points from those, and then I'm just going to go through some chart examples. I've got about 15 examples to go through, and then I'm just going to open up to Q&A. Okay, so to start with, false breakouts are all about order flow. Okay, the concepts behind a false breakout is what I described in the first or second video, probably the first video, I don't recall now, but it's all about order flow. So if we summarize why a false breakout works, we can do it in one slide essentially. And it's all about looking at areas where we expect breakouts to occur. Okay, areas where we expect breakouts to occur is areas where we have order flow concentration, high order flow concentration. And that gives the ability to trap traders on the wrong side of the market, okay? So if I go to another slide first. If we look at this SR, what is happening here in terms of order flow or order concentration, we have stops from anyone short clustered above these highs. Why? Because that's herd mentality. That's what people do. They place their stops above logical swing high points or beyond SR levels or beyond wedges or whatever, beyond round numbers, etc. Okay? All we're looking for is areas where there is order concentration. Okay, so there's going to be stops from sellers from shorts here, and there's going to be breakout traders looking to go long on the breakout. Okay, so that leads to a high buy side order flow concentration. Okay, so that's why we get what we term the breakout rush. This is what we typically see at a breakout. A rush. Why? Because there's a lack of liquidity on the short side relative to the high order flow concentration on the buy side. Because this is an area where we have a relatively high or unusually high order flow concentration balanced to the one side. On this side, on this occasion, it's obviously the buy side. Okay, so that's what, whenever we're looking for false breakouts, we're always looking at locations where we know we have that type of order concentration. SRs and swing points are two obvious ones. There are others, but they are the most obvious ones, and they're the ones I mostly concentrate on myself. Okay, so price accelerates upon a breakout, and that leads to the breakout rush. Okay, if prices quickly reverse, that tells us that we had strong supply or demand come into the market to reverse what we know is strong one-sided order flow. Okay, so on this occasion, this isn't obviously a false breakout, but if this was reversed, we would have strong supply that came in here to reverse what we know is strong buy-side order flow. And that tells us that this supply must have been very strong to reverse what we know is strong buy-side order flow. Okay? And price closing back within that range leads to a false breakout. Now it's what happens after that false breakout occurs which gives us the price action that we trade. And that is the fact that anyone that went long on the breakout here is now caught in drawdown. So what they're going to be looking to do, they're going to be looking to start exit. As they start to exit, that's the same as selling, isn't it? Opposite buying is selling, so therefore that is what part of what causes price to accelerate after the false breakout occurs, and that's the price action that we trade. Traders caught on the wrong side of the market exiting. There's also new traders coming in. Anyone that sees a false breakout or sees price closing below there, that's also another reason for new sellers to come into the market. And we know if price was reversed strongly after the breakout, that we had institutional supply that caused the false breakout. So therefore we have institutional money on our side in any case. So it's order flow, but also there's obviously other motivations why people are buying and selling at these areas as well. But what we're interested in is the order flow and the price action it generates. Okay. And lastly, the order flow concentration at the breakout is used by the large players as liquidity. Okay, that order flow, that buy-side order flow is essentially large liquidity, which can be used by the large players who are looking to short up here. They've got large buy-side liquidity to get their shorts in without getting slippage, for example. Okay, and that's just a pretty much, in a nutshell, what a forced breakout is. It's actually very simple. All you need to do is understand simple mechanics or simple order flow dynamics in terms of types of market participants, where those market participants occur, i.e. where they're concentrated, and the types of orders they represent. So that's the number one question. When we're always looking for a forced breakout setup, the number one question we ask ourselves is there going to be this type of order flow concentration? Is it logical to conclude that we do have a build-up of this type of order flow concentration? SRs and swing points are two obvious ones, but there are others. Wedges, round numbers. I don't trade round numbers myself, but round numbers is an obvious one because people put orders around round numbers because there are a psychological element to them. Now, I don't personally trade them, but some people do. Wedges, you get option barriers around round numbers, for example. So there is a large build-up of order flow concentration around big round numbers. Wedges, clear trend lines, etc. But SRs and swing points are the two I concentrate on. Okay, so that's the first step, looking at order flow. And we know what a forced breakout is. We're looking for a close back below the SR, and then we know what the price action that should generate because of the order flow involved. Okay, the next thing I went over was material forced breakouts. In terms of the type of forced breakouts I'm looking for is material size forced breakouts. And the reason why is so that can conclude with good probability that breakout traders have been caught on the wrong side of the market. A small breakout doesn't necessarily tell us this. And that the most important one is that we can conclude with good probability that a forced breakout is not supply and demand consumption. And that is an important point that is probably not well understood by a lot of people, especially in the concept of supply and demand in itself, and then supply and demand consumption. And this is more important for swing forced breakouts, where you're more likely to have price approaching the area with stronger momentum and potentially in an impulsive manner. Okay, and then, which I'll come on to in a minute. But and then lastly, so stops can be placed in logical and objective locations. So we can use the bar highs because we've had a material forced breakout. We can use the bar highs as a place to put our stop loss beyond, because obviously price breaches that bar high, bar low, then obviously the forced breakout has failed. Okay, so just remember this slide from one of the videos. Just taking a step back and talking about supply and demand consumption. Within this bar here, this is a rejection. Say we have demand or support down there. This is the rejection from support, okay? But what we're more interested in is what this tells us about the most logical, most likely price action that's going to occur next. Now, if it's true rejection, it's going to lead to price shooting upwards, continuing in the same direction of the initial rejection. But this also could be demand consumption. And by that I mean, in reacting from the demand down here, it's also consumed some of the demands down here. So I cleared some of the demand down there. So if this is a strong trend down, this could be just a pause in that trend, clearing the demand in the way, so the selling pressure can take over and be easily pushed down. Okay, so that's why one of the reasons why I look for material forced breakouts, because there can be the uncertainty whether a forced breakout is supply demand consumption or a true forced breakout, i.e. a true rejection leading to a continuous rejection. And small forced breakouts, especially when going against strong trends, there can be a lot of uncertainty regarding this. So that's why I look for material forced breakouts, because the bigger the rejection, the less likely it is to be a supply demand consumption bar, and the more likely it is to lead to true rejection, i.e. a true forced breakout and the order flow take over. Now, one of the ways we can overcome a material forced breakout is to spot supply and demand that price is reacting from. We know that supply and demand represents institutional money. Therefore, if we can see that in causing the forced breakout rejection bar, it's hit institutional supply and demand, that gives us more confidence that the logical outcome is that that rejection bar is actually a true false breakout, a true rejection bar, and not a supply and demand consumption bar. Okay. So for example, again, these are just recap slides from the videos. A swing false breakout, we have a strong trend, we have a small rejection. You see this doesn't stand out at all relative to all the preceding rejections. I would look at this and I would say there's too much uncertainty there. Without any more information, there's too much uncertainty to take a false breakout trade there. Why? Because I can't tell whether that's just demand consumption paving the way for price to continue within this impulsive strong trend move, or whether it's actually a true rejection from demand and a true trapping of traders on the wrong side of the market and a false breakout. It's more 50-50, and I don't take 50-50 trades. So without any information there, I can't conclude either way what's more likely, so therefore I don't take a trade in those scenarios. Now, as I said, the way we can overcome the lack of a material false breakout is to find supply and demand that price is reacting in. So if there was a clear demand zone here, then I would conclude that actually this is more likely to be a true rejection, i.e. a false breakout, and then I'll therefore be more comfortable taking a long. And this also has the advantages that we can pre-plan scenarios in advance. False breakouts aren't the easiest setups to plan. Yes, you can pre-plan support resistance areas you can look for and swing points you can look for. I do, but it's much easier to be able to plan scenarios where you have a support resistance or swing high low next to a clear supply and demand zone, because you know straight away if price reacts off there, that's going to likely give you a setup. So here's an example. We have a clear value-based rally here, which led to the actual breakout. An extremely clear SR, relatively small false breakout. It's a 2-bar false breakout, so this was a H1 time frame. This will be a H2 false breakout. And because it's hit demand, and it's the first time back to this demand, coupled with the clear SR, etc., it's very logical to conclude that this is very likely a false breakout, and it's going to lead to price going back up to these range highs. Okay, but without that demand being there, this becomes a lower probability setup because the uncertainty over whether it's a true false breakout or demand consumption increases. So that's one of the most important questions I ask myself when considering or analysing a false breakout setup. Is this a true rejection, or is this more likely to be supply-demand consumption? And this is particularly important for swing false breakouts, as I said, because a support resistance false breakout, you're more likely to have a sideways moving market, or price at least moving sideways within the constraints of that recent price action amongst that SR. But within a swing FB, also you're going to have price coming back in a kind of U or V shaped, and therefore you could potentially have price coming back with strong momentum in an impulsive manner. Combine that with combine an impulsive move with a small false breakout, that's much more likely to be supply demand consumption than it is a true rejection and thus a false breakout. It doesn't mean obviously every single occasion that occurs, but more often than not that will occur, and that's something I won't take a trade on. So to overcome that, we look for material false breakouts or clear supply demand that price reacted to and causing the false breakout. And these are the type of considerations I look at. I mean, I'm not a rule-based trader. I don't like rule-based trading. I think it's an inefficient way to trade. Okay, everything I do is based on just considering certain points and coming to a conclusion based on certain considerations, weighing the setup as a whole. Everyone loves rule-based trading because it's easy, much easier. But it's much easier to make money if you just consider the setup as a whole. So I produce a list of, obviously I'm an experienced trader, so I don't go over a single point when I'm doing it, because a lot of it becomes intuitive once you become experienced. But I still keep these, on my desk, and they're there to refer to if I'm having problems analysing the setup. So for an SRFB, is a setup at clear support resistance pretty obvious? We want clear support resistance because the clearer the support resistance, the more likely other people are looking at in terms of breakout traders, the more likely you are to have the stops build up, etc. Is the market strongly trending or ranging? Obviously prefer a ranging market rather than a trending market, because we don't want those impulsive moves. Is there a clear build up of stops? That's about the history of the SR. Obviously the more history there is at the SR, the more the build up of stops, but obviously you have to counter that also with the fact that you don't want to be going 10th time an SR in a bullish wedge scenario if it's on, because it's more likely to be a breakout. So you have to consider, you have to be sensible about it, but you want to be able to conclude that there is a build up of stops there and a build up of breakout trader orders. Is there a clear buy, seller trap? Obviously the trap is breakout traders getting caught alongside the market. So we're looking for the material false breakout or price hitting the clear fresh supply demand. Is the setup the result of an FTB setup, first time back setup? That provides us a confluence. Sometimes you'll find them go hand in hand. You get a first time back, released to a false breakout of a very close SR. And obviously that's a powerful confluence setup. Is there uncertainty over whether the FB borrows supply demand consumption? Obviously been over that. And do we have a pause consolidation SR test just before the FB? This is more important that's more important for swing FBs than SRs in terms of a pause consolidation and SR test confirms the SR still has supply and demand within it, it confirms it as a decision point. And therefore when we have the breakout above it and then the close back below, we've had essentially supply demand flip to supply demand again, and that's been cleared. It's hard to explain without an example. I'll go over it in an example when we come into the charts. Similar sort of thing for swings. You want a very clear swing high, swing low. Was there good supply demand imbalance at the initial swing high low? Did it leave with good momentum? Does it have that good visual double bottom, double top look to it, either the yield, the inverted yield, V, inverted V? You want clear space between the swings. I don't want price going back in a couple of bars. Why? Because there's no chance for orders to get built up. You want a chance for orders to get built up at that swing. And again, the same sort of considerations. Is there a clear seller buyer trap? A material false breakout or price hitting supply and demand? Obviously at a swing point, it's less likely price is going to be hitting supply and demand, because we could be looking at all-time swing highs or swing highs where there hasn't been price near it for a long period of time. There's not any close to supply and demand, just above, just below. Is the market trending or moving sideways? Again, my big no-no is generally strong impulsive moves combined with a small false breakout. And again, the supply demand consumption question and the pause consolidation swing test, which I'll go over in a minute. So there, if you're new to trading false breakouts, they're this type of things you should be asking yourself when you analyze each setup. I said, I'm not a rule-based trader. I just consider each setup on its own merits and based on experience. Obviously, you're looking over past charts and having traded it for a long time. I don't do things like adding up a score in terms of rating each one of those and giving them a score or anything like that. It's just about looking at it and being able to be objective about it, be able to conclude, yeah, this is tradable. Probabilities are stacked in my favour, but this is more likely to be a false breakout setup, therefore it's worth parting with some risk. Okay, so those were the things I went over in the videos in terms of how to analyze the setup, and the last thing was trade management. Okay, the simplest entry is obviously at the bar close, or on a retrace, or because you can do both, you can split your orders on a retrace back to the broken swing or SR. Something I've noticed over time is if price close is close to the SR, then it's more likely to retrace back to the SR to pick up new orders before taking off. Obviously, if the close is well beyond the SR or swing point, it's less likely to come back, and actually you probably don't want it coming back. Okay, same with stops. Obviously, the false breakout is invalidated if the bar high low, bar extreme has been broken. I'm looking for specific setups where I know price is going to go at a specific moment in time after that bar, so I don't want that bar to be breached again. The setup is completely invalidated because I haven't traded the actual false breakout. Okay, and there are times where you can place a tighter stop. Again, it's not do this, this, and this. It's kind of you have to consider the setup on its own merits. But in terms of what I consider, in terms of if it's a very strong rejection bar, then I'm less likely to put my stop beyond the FB bar high because I don't expect it to come close to that FB bar high again. If it's a clear, very clear SR, like an extremely clear in terms of very precise in terms of the previous tests have been all very, like within 1-2 pips, then that suggests to me that price shouldn't go beyond that SR again because supply to demand within that SR is very, very concise. And if there's clear basing before the false breakout, i.e. if there's clear basing and you have a price breaks to the long side then closes to the short side, that basing is a consolidation zone, which is a former demand zone, which is now turning into a supply zone. Therefore, I don't expect it to be breached on any retrace. Okay, so those type of things, situations or scenarios where I will consider a tighter stop loss, but it doesn't mean I always do that. It's kind of you get a sense, you get a sense over time, and also that's what back testing and doing due diligence does. Looking over hundreds of setups, you get to know the ones where you can put a tighter stop loss, and the ones where it's safer to leave it beyond the bar high, bar low. And in terms of the mindset approach, everything I look at in terms of expectancy. I don't like the whole term of being picky and focusing on high win rate. I don't think that's the right approach to trading. I focus on expectancy, what will make me the highest profit if I did it 100 times, not what's going to give me the highest win rate if I take it 100 times. People that are focused on higher win rate are people that have confidence issues or have problems accepting losers, etc. You've got to, when it comes to your mindset approach, you have to be as robotic as possible. Trade what you know will make you the most money if you repeat it 100 times, not what will give you the highest win rate if you did it 100 times. Okay, and expectancy, if people don't know, expectancy is a function of your average winner, your average risk reward times your win rate, and then you multiply that by your trade frequency. But too often in the retail space, people are focused on being picky and having a high win rate. Why? Because high win rate gives confidence, and people don't like losing. Well, I mean, no one likes losing, but I don't like losing, but it's part of the game, it's part of the business. I try and focus on trading what will give me the highest net profit over the long term, not what will give me the highest win rate. So thinking in terms of expectancy, thinking in terms of risk probabilities, analysing and set up objectively, taking all those considerations into account and thinking, is the balance of probabilities in my favour? This is an FB, a true FB setup. Some setups are better than others, which is something that comes down to experience over time. And that's where you can vary your risk. But I want to always take a setup where I know if I did that to the 100 times with the same stop loss and entry, I will make more. I will make profit. Okay. And lastly, exits. Now, I haven't really gone into exits in a lot of detail in my videos. And the reason for that is exits are, well, they're a whole subject in their own right. In terms of when to hold a trade, when to run it, when to exit the FL, IFLS. That's a whole separate video. And part of that is down to personality as well. I'm very much an intraday trader and I'm very much a momentum trader. I don't run trades because it doesn't suit my style. I'm not very good at holding trades. Therefore, I focus on taking high momentum trades and get out of the FLI, FLS unless I have a very good reason, unless I can conclude with pretty good probability, actually this is worth running it because of XXX, okay? So all I focus on in teaching these videos and things like that is how to identify the FLI, FLS, okay? First line of resistance, first line of support. Okay, and the FLI, FLS is pretty simple. It's just a support resistance or supply demand area that we expect price could react at after the actual FB reaction. Now, the other thing to look at is potentially look at is price action. In terms of false breakouts, all about order flow, and we know that the price action that should occur after the false breakout is strong momentum because of the order flow that occurs, i.e. traders exiting their positions and new buyers, sellers coming into the market. So we expect a good momentum move following a false breakout. And if we don't get that good momentum move, and I don't mean price moving straight away within minutes of the force breakout occurring. And I do see people do this and have done this in the past because people don't trade with confidence and are too itchy finger in terms of zooming in and trying to watch their trade on the lower time frames, and if it doesn't go straight away, that they're looking for a reason to exit. You've got to let a trade play out. So for me, again, I don't like saying numbers because I don't like quoting rules, etc. But if a trade hasn't gone, if it's a 1 hour bar setup, for example, and 3 hours later it hasn't gone, then for me there's something wrong with that. Generally speaking, it doesn't always occur. And I'm going to show you an example of one that did work out but didn't move quickly, one that occurred yesterday. But it doesn't mean that, like I said, that should always occur. But on the balance of probabilities, a false breakout will always, should most of the time, result in a good momentum move. So when that doesn't occur, that price action doesn't occur, we can look at reasons why and potentially look to cut our trade or cut part of our trade. The way I look at it is, I never, well not never, but it's only used for me to cut all of my trade if price isn't moving with that good momentum, because I know that doesn't always happen. Most of the time it does, but not always. But what I look at it is this sellout still as good as it was when I first took it? If I can logically conclude no, then I'll cut half of it. That's the standard thing I do, and I'll leave the other half because it could still work out. And unless I can see a reason why it's blatantly not working out, then I'll cut all of it. But if it's just because price isn't moving as I expected and I can't see a reason why it's not moving as I expected, then I'll just, as a matter of course, cut half of it. And that to me is normally a few bars after the false breakout has occurred. And that's one of the good things about false breakouts. You know how price should move, and therefore you know the exact price action, and you can act accordingly if it doesn't occur. But it is important to let the trade play out, and just because it doesn't move on the next bar or the next few minutes after the bar, you've got to let it play out and have confidence in your trade still. There's a fine line there at times. Okay, so that's pretty much a summary of the 5 videos. There's one more thing, but I'll come back to that. That's something different. So now I'm going to go over some chart examples, so I'll get off the slideshow. If you have any questions, just ask them as I go along and I'll come to them at appropriate points. Bear with me a minute. I pretty much look on any time. I mean, I am an intraday trader, so I don't look at weekly and monthly. I do look at daily, and there are times I do trade. I am trying to get into the habit a bit more, trying to trade simple, straightforward, daily time frame trades as they are. I do find it hard to, because I'm always trying to look in and zoom in and try and find a better entry. But sometimes you do miss out for trying to overcomplicate it. So I am an intraday trader, so most of my trades are based around H4, H1 and beyond, down to M5 and M1. Pretty much the MT4, because I use MT4 for charting. All the time frames you see here, I trade them on. So I have, the way I sort my trading is I have a whole host of pairs that I look at on H4 and H1 and daily, and then I have my intraday pair list, which is obviously more the majors rather than the exotic ends in terms of FX pairs, and those are the pairs which I will look at on lower time frames, and where constantly during the day I'm looking for lower time frame setups, so M5s, M1s, M15s of this world. But the more crosses and exotic ends of the spectrum, I'm more likely to look at on H1, H4 and daily. And obviously I trade non-FX as well, not money, but indices as well. And again, I have pairs I watch intraday, like FTSE, DAX, CAC, Brent, and I have other pairs which I just watch on H1, H4, M30 or around those time frames, which is S&P, Dow, Nasdaq. etc. But any time frame for me, time frame is not important. That's not a simple answer. Like, I haven't taken any this week, for example, but I would carry that in terms of actually trade different ways as well that I haven't explained here. See, this is the basic way of trading force breakouts, but I actually have an advanced way of trading them as well, which for me suits me better because it gives me better R and better, more well-defined entries, but it's much more advanced in terms of the price action involved and what to look for and the time frames you look at them on. But in terms of, like, so for example, I haven't taken any straightforward ones this week. There have been some and I've missed a couple. But it depends on the markets as well, because the best FBs occur in sideways moving markets, in my opinion, not strong trends. Like, you can look at the yen pairs, you look at H1 on the yen pairs, obviously most of the time, apart from the last few days, obviously, most of the time it's just going up. You're not going to have any swing points unless you're looking well back in the past, or any SRs accumulate. So you haven't got any order flow concentration, so you haven't got any areas. So all the yen pairs pretty much haven't had, and if you're looking at the higher time frames, also if you look at M5, then you're going to get SRs and swing points on the M5 time frame because that's more within the bigger moves. Also, you're going to get consolidation within the bigger moves. But if you're looking at those pairs, for example, you're not going to have many setups at the moment. So it goes in kind of fits and starts, and obviously I trade other things like FTBs, and I find them mix and match. When there's a lot of FTBs, there's not a lot of FBs, and vice versa, because FTBs work better in trending markets where you have pullbacks and things like that, whereas if you have a sideways moving market, you're not going to get those clear momentum move aways, and therefore you're not going to get many FTB setups. But in a clear ranging market, you're going to get a fair few FB setups. So it all depends on what time frames you watch and how many pairs you watch as well. But in the case of the week, you should be able to find a handful of setups per week. But it does, if you want, it really does come down to how many pairs and what time frames you watch on. But I wouldn't discriminate between time frames when I'm looking at a setup. Obviously, I have a top-down analysis approach in terms of I do look at a daily H4, H1, and I do give, obviously I'm going to take notice of a daily supply-demand zone and a daily SR, but if an M5 setup appears in isolation, I will take it, and I won't penalise it because it's an M5 time frame. Well, I always have more preference for the majors over exotic pairs. Like, I'm not going to say to someone, yeah, go and watch Euro NOK, because it's a liquid pair, but the setups I'm going through now are all from various pairs. There's one per pair. Let's go down and you can see. But I can find setups from every pair, but you will find more from the more liquid pairs, in my opinion. So I would pick just a diverse number. Like, you don't want to watch all the yen pairs because they're all following dollar yen at the moment, or have been for the most part, and therefore it's more likely they're all going to set up or not set up. You want some diversity. So if you're watching FX, you watch a couple of yen pairs, a couple of dollar pairs, a couple of crosses, a couple of exotics, pick some indices. Again, if you look at the indices at the moment, just look at what the markets are doing in terms of a lot of the indices markets aren't doing much in terms of they're in big ranges. But I would look at things like CAC, DAX, FTSE, maybe not the FTSE so much, FTSE and DAX together, but pick a US market, a European market. If you're into fixed income, some treasury markets, but just make sure you have some diversity. But the important thing is to backtest in terms of go over and build up a library of setups yourself. It's one of the most important things to do in terms of due diligence. I don't really notice any differences on time frames in terms of peculiarities. You notice differences on pairs, and that's something I'll come on to in a minute. I've gone through these, but not so much on time frames. So if I start going through these, if I start left, actually let me look at silver first. Silver is an example of an FB last night which didn't move quickly but still worked out. No, this is not one I took. It's too late in the day for me to take it. I'm not normally looking at my charts this time of day, but you can see we have a clear supply zone, very clear base drop there, very clear swing high, H1, reaction from that supply, good rejection, no strong impulsive move up. It's a standard false breakout, but it occurs at 6 p.m. GMT, so that's kind of getting to the time of day where I'm not watching the market, for example. The market obviously slows down after European close, coming into New York close, in New York afternoon session. And obviously FB's being about momentum means I'm very unlikely to take a trade that's going to approach New York close, especially going into the pre-Asia market and into Asia. I don't generally myself take trades when I'm not at my desk watching them. But as you can see, it worked out. But obviously we went through 7, 8, 9, 10, 11, went through all the pre-Asia, the New York close and pre-Asia, and then actually it started moving 7 o'clock this morning. Frankfurt open, London open, and obviously that's not a surprise considering that's when the much larger liquidity and much larger players come back into the market. But just an example of ones where you do expect good momentum, but they don't always have good momentum, and they do still work out at times. Okay, so Aussie CAD, daily time frame. Here we have a swing high. It's not the most obvious swing high compared to say this swing high, but it's got SR history as well. I'll zoom out, and you can see there's SR history along there. It's a 2-day FB. And you can see we've had another test up here. We've had that basing before. So that confirms this is still resistance, confirms this is still supply. Therefore, we know there's going to be order flow build up above here. We have a material false breakout, and as I said, it's a 2-day close. I don't care about whether it's a day, 2-day, H4, H8. That doesn't really bother me. And if you look at this as a 2-day FB, a nice close below, it's a standard FB. We have an uptrend, but it's not impulsive. It's not these bars down on here. If it was after these bars, that would be considered impulsive. But if you look at, it just looks like an uptrend, a standard uptrend. Okay, so in terms of the FLS, now this would be the closest SR. Then we'd be looking at, there's an SR flip along there, and also this is the demand that led to the move up. Now, I'm not going to exit here. I'm never going to take a trade. That means getting out down here, because the R on that's going to be just stupidly low. But I also expect to move beyond this SR, because you have to consider what an FB setup is. It suggests we're going to have a strong order flow based move, and that should be enough to overcome very close SRs, very close demand zones, and this is extremely close. So if this doesn't work out, then that says something to me that either there's something here that I missed in terms of the demand sitting here, or the order flow that resulted from here just wasn't strong enough. It just wasn't what it should have been, because you should have that quick, strong momentum move, and you can see the way it did move. It's a typical way a false breakout moves with strong momentum. So that should be enough to overcome close SRs like this. This isn't, and it's not an SR that hasn't been tested, right? It's been tested twice already as well. So combine those together, and I would trade this, and I would be looking where it went to down here. Obviously it went lower as well, but this is where my FLS would be. Stop loss, I would look at above this high plus a buffer plus spread. I wouldn't look at the bar high. Rejections from quite high up. I wouldn't expect price to come back in this vicinity again. Be looking for this SR to hold on any retest, but you've got to allow for a bit of an overshoot. So halfway up the bar again. I'm not about rules in terms of 50% of the bar or anything like that. Just look at it and be objective about it. The rejection's quite strong, a big rejection. Therefore, I don't expect price to come close to the high. So I'm going to look to tighten it somewhat. But I don't want to get stupidly tight where it might overshoot a little bit but still work out, because obviously that's pretty frustrating when that occurs. You don't want to be too greedy and miss out on the setup. Okay, and if I look at H4, there's also a recent example. Similar type example. This is a H4 chart, so this is a H8 setup. Okay, similar thing. We have an SR, much clearer SR than the last one. Now the move up is a little bit impulsive as we get up here, but we have some basing before in terms of we have a rejection from this area before, then we have the material false breakout, because obviously this is H8, so it's a 2-bar false breakout. It's material false breakout above this SR. That combined with that basing would be enough for me to take this. Now, it's not one I vary my risk on setups. For example, if I took 3% as my maximum, this is not going to be a 3% setup, because there still is some uncertainty because of impulsive move up. But I do know, because of the way this moved up, that if this does go, it should shoot down in the same way it went up, because this represents a lack of liquidity. Price moves fast, i.e. if we think back to when we had the breakout rush, that was because of a lack of liquidity on one side of the market. Well, the same's happening here. There's a lack of liquidity on the sell side, so that suggests price should move down in the same fashion because there's a liquidity vacuum of sorts within here. Okay, and obviously the target's going to be this demand which led to the move up. Pretty clear. Pound Swiss franc H1. This has SR, but it's kind of a mixture of an SR and a minor swing low. But it's been a support resistance flip, and obviously there's lots of space between the last time price has been around this area, so there's going to be order flow build up, order concentration build up, I should say. Price has hit a clear demand zone. Again, this is one where without this demand zone there, I wouldn't necessarily want to take this because the false breakout's too small. Okay, it's a very small false breakout in terms of the materiality of it, but because it's hitting demand, that's information I need to tell me we've hit an institutional demand here. This is more likely, despite the strong move down, this is more likely to be rejection and lead to a false breakout. It is a strong move down. You can see all the most recent moves are strong selling, so I'm not going to outstand my welcome, and it actually compresses up to the supply within this bar. And on something like this, my stop loss is going to go below the low because there's no point having it on a small false breakout. There's no point tightening it because you're more likely to take a loss if you do that. There's nowhere logical to do it. You've got one swing point there. It's not as if it's a very clear SR that's been hit lots of times, and you see price comes back. So looking for the retrace entry there is pretty logical as well. Pound New Zealand dollar M30, again just another standard example. Supply zone, support resistance zone. We have the strong move up. We kind of expect that. We expect that strong momentum there because it's a breakout above this area. So we expect the breakout rush to be occurring above here, so that's no surprise. But the preceding movement below that is not strong trending, it's not impulsive. And then we have the basing that forms again, confirms this SNS SR. And that means we have supply within there, and that turns demand when we have the rejection come down, and obviously price needs to overcome that as demand. So that tells us that the rejection was strong and it's coming from supply. Now if you were looking to tighten your stop loss, you might get stopped out on this one. And also it's very hard to look at this now and say, yeah, my stop loss would be above there and not down here, considering what it did. But it might be one where you do get stopped out if you look to tighten your stop loss because it did retrace 3/4 of the way up the bar. But that's where you trade according to positive expectancy rather than win rate comes into mind. If I know if I took this 100 times and 80 times would result, if I had my stop loss down here above this bar high plus a little bit of a buffer plus spread, if 80 times over 100 that would result in a winning trade, and 20 times it would result in a losing trade, and that 80 times over 20 gave me a higher net profit than having my stop loss up here, then I would do that. It would result in a lower win rate, slightly lower win rate, but it would produce me next higher net profit over the long term, and that's what trading according to positive expectancy means. Okay, and then this broken SR area would be my FLS. So it went lower, but that's the FLS for me. Euro New Zealand dollar, another SR example. So these are kind of my favorite type of setups. SR, sideways moving market, clear demand it's hitting. There's nothing not to like about that setup. It's a high probability that price is going to go up and hit that FLS, FLR even. And you see this is just a clear support that was broken. We had the breakout down, rejection from demand, clear SR, sideways moving, nothing impulsive, nothing trending about it. It's very high probability that it's going to hit this form of support and now turn resistance. And again, you get the strong momentum move up. Euro Aussie dollar. This one we don't have any supply to the left, so we have to judge it on its own. Clear resistance, clear false breakout in terms of the size of the false breakout. And obviously we have a support along there, or you could be looking at demand within here. but we get the strong momentum move. Now this is one where my stop loss on this isn't going to go above the bar high because this is a very strong rejection. It's not going to go above there because I don't expect, if its price starts coming back there, I'd be concerned anyway. It's less likely to work out. If price starts coming up there, then it stands a chance of doing that, holding this as support. So if, for example, price closed above this area, if my stop loss was above here and price closed above this SR on the H1, then that suggests that's now a breakout again. So it suggests that this is more likely to hold a support. Therefore, I'm going to definitely exit my trade when that occurs, because the setup is nowhere near as good as it was when I first took it, and the close back above a level is a basis of a breakout, isn't it? So my stop loss is going to be placed like halfway or 3/4 up, just something slightly tighter, because I don't expect it to come anywhere close to there. So I'd say about there, say for example, plus spread. You want to get it a little bit of room, so if it does overshoot a little bit, you do want to get a little bit of room. You don't want to get too greedy with it, but you should be able to look at that and say, I don't expect the price to come above that high again. And if it does start coming back up above here, it's more likely to be going higher anyway. Therefore, I don't want to be in the trade. Yeah, that was a good FTB further on high there. No one's trading December the 28th though. At 6 o'clock in the morning, whatever it was. Oh no, it's an afternoon, but December 28th, no. Okay, in terms of what broker do I use? This is FX Pro, but I use FXCM. Okay, don't sleep. No, I use FXCM, which is GMT actually, but there's no specific reason. It's not because it's GMT I use it. It's just I like the feed, and it's one of my spread betting brokers. So I've used many brokers over the time, and many feeds as well. I've used FX Pro in the past. I use FX Pro for daily charts because I like the new. Well, it doesn't close. Obviously, the FX market doesn't close, but in terms of the New York close, FX Pro closes half an hour after that, and I like that type of daily. So I use them for daily charts only. I look at dailies separate to intraday, so I use them for that. But I use mainly FXCM and just for FX. But GMT close also doesn't bother me for intraday trading. Dollar yen, yeah, daily we I haven't looked at other brokers on it because I've always used FX Pro for daily closes. So I don't know. I don't actually know if there is any. Because, for example, I used to use Oanda to trade, which I don't anymore, and their daily close was something like 5 a.m. They were something like 5 a.m. So I've never fully investigated whether different daily closes based on different session overlaps actually makes any difference. But obviously a lot of people do look at New York close and around that time as the daily close, even though the FX market doesn't close. So I have no reason I have no reason not to look at that. So what's this? Dollar yen, H4. Again, simple one. Supply, swing high. Now we do have an impulsive move up, so that would be a concern. But if you look at the size of the rejection, and you can see where it's being rejected from, without that supply being there, there's a hell of a lot more uncertainty over this. But because we know it's hitting supply and the way it's being rejected of that supply, and the fact it's overcome a good chunk of that strong impulsive move, I stopped it on a nail essentially for all intents and purposes. But that makes it tradable. Yeah, it doesn't make it the best seller I'm ever going to see, but it makes it tradable. And again, I don't expect now, obviously, volatility is relatively high. You can see that by all this price action within here. So I would be a little bit more cautious with my stop loss. But again, I wouldn't expect it to come back to this supply again. Once it's been rejected on the first time back, I don't expect it to come back again. I expect this resistance to hold, but it might overshoot. So I would put it, towards the high, but I wouldn't put it above the high. If you get a little bit of a tighter stop loss to increase your R, so be it. But you don't want to be too greedy with it that you end up with a losing trade when it went and did its thing, because there's nothing more frustrating than that, of course. well, very few things. Pound yen, pound yen, H4, and a slightly different one. This is a very strong impulsive move down, but this is where you've got to weigh up what price is telling you. Okay, now again, this is not going to be my favourite setup out there. We have an extremely clear swing low. The cap price left it last. We have a very material false breakout of it, and if you look at the actual rejection itself in total, because it's not just obviously the false breakout, it's this whole area here from the low to the close. That is a very strong rejection from something that we can't see. There's nothing to the left, so it's new demand that price has found to overcome or stop in its tracks this very strong trending move. And normally I wouldn't like a strong trending move, but when you've got a very big rejection like that, that says to me that this is more likely to be rejection and not demand consumption. Now if it's a small, if it closes down here and this, if it does this, it closes down there and the false breakout's down there, then I'm not going to trade there, never. Because that just says to me that's more likely to be demand consumption. It's more likely to be just a little pause in the trend, clearing demand in the way for trend continuation. But that stands out to me as very strong rejection, the overall rejection. So I would trade that. But again, it's not going to be my favourite setup. It's not going to be one I have maximum risk on or anything like that, but it's tradable. Where is my stop loss going to be? Again, it's not going to be below there. I'm not spending price this on things like this in terms of you're looking for a mean reversion move, or are you looking for a quick snapback like the elastic band effect? So I'm not looking for price to start coming lower again. If it does, then that's not a good sign when you've got an impulsive move behind you. So I'm not looking at it to start doing that, because that then suggests to me actually this was demand consumption. If it starts coming down here, then it's very low chance of it working out. So I do expect it just to go. You're looking for that quick snapback when you've got impulsive moves behind you. Again, this is an example where you've got the close SR and you've got to weigh up, is the order flow from the FB likely to be stronger than a close SR? Obviously, if you don't think that, then you're not going to take it because there's not any value, or there's maybe value, depending on what you consider value to that area. But I would be looking for a move to the next area, which obviously is this clear SR up here. Especially when you are going against the quick, you are looking for the quick snapback. There should be momentum, there should be energy behind this. I always think of it as an elastic band effect. Euro yen M5. Now this is an example of one I wouldn't take, because unlike the last example, if you look at the total rejection, it's very small. Bars close right on the swing low. The actual trend down, if you go back to the other one, the trend down is not strong on this. The rejection is very big. The trend down is much stronger, coming from a much further distance, completely impulsive. And it's travelled nearly 100 pips, and this is a 5-minute chart, obviously. So 100 pips in the space of what, half an hour. That's a fair amount, even for Euro yen. So a small phase, if it's this bar, then I would be more likely to be considering it, because this is a strong rejection. Obviously, this doesn't close as a false breakout. This one does, and this one just says to me this is much more likely to be demand consumption. There's too much uncertainty within that. There's no other information taken into account. It's just not tradable for me. As I said, if it's this bar, then it would be, because that's a very strong rejection. So that's what you've got to consider when you've got impulsive moves. You've got to consider, is that bar telling you it's more likely to be rejection over demand, supply to consumption, or is there too much uncertainty to not want to take a trade? Dollar CAD, this was last week, and this is actually one of my favorite recent setups I've seen. I actually missed this, which was really annoying. I was actually trading it in a different way. I was zooming in and trying to trade it on M1, and I messed it up and didn't get in. I should have kept it simple. There's a couple of us who were trying to look for an M1 based on something else, but I missed it and it didn't come back. So you look stupid when that happens. But this was a great example. If you look, if I zoom out for a minute, You can see it has importance on the daily time frame. It's a daily swing low. Has importance on the H4. It's a H4 SR and swing low. M1, you've had a recent touch to confirm as support in terms of still demand there. We had a sideways move in recent range. And on M30, you've got as big as rejection as you're going to see on this pair, dollar CAD, which is a heavily mean reversing pair at the best of times. So this is a no-brainer one for me. Okay, yeah, I do like the ones where you have supply and demand below, but I don't need supply and demand below when you've got a rejection like this. This is so strong. If you look at this rejection and compare it to all this recent price action, it just completely stands out. And there's only one place this is going, back up to that range highs. It's a no-brainer, it's a slam dunk, whatever you want to call it. It's money in the bank and it's straight up to there. Not going to have a stop loss below the low, of course, that's just way too low. On a setup like that, you've got to expect price to just go. You shouldn't be hanging around. So, you could argue a really tight stop loss. I'd probably be a little bit more conservative and be like somewhere down there or something like that. But this is a very clear area and it's a very big rejection. So therefore, after a big rejection like that, obviously there's strong momentum behind this rejection. Therefore, you do expect that strong momentum continuation, especially when you've got the false breakout order flow behind it. So, that is probably trade of the year that I've seen so far in terms of false breakouts, or setup of the year because I didn't trade it. Aussie dollar M15 is a couple on this one. Let me just go back over some questions. Yeah, I say 3% as an arbitrary number. If I was rating a setup between 1, 2, and 3, that would be a top dollar. That would be 3%. I don't necessarily risk 3% per setup. Yeah, well, full risk within whatever your maximum risk is. Obviously, not 100% risk. Not sure if I saw. How would you gauge which time frame to be looking at, given that it's a daily H4 level? I wouldn't be looking at daily, obviously, because I'm not a daily trader. Let me go back. But that's where pre-planning comes in terms of you have that marked because it's a daily level, because it's a daily swing low. You have it marked, you know it's a H4. You have your alert set for when it gets towards that low. That's what I do. I have my alert set for when it comes closer, when I start watching it. It's H1 or M30. I just did M30 because it looks like it's a pin bar and everyone loves pins, don't they, in retail, so I thought it'd be visually more inspiring for some people. But it's whatever time frame you want to call it. It's H1 M30. It's the same thing. Also, it's the same trade. H4 is to close higher, but obviously depends on what pairs you look at and what time frames. Something like this. At the time I did see the M30 form and I did zoom in to try and get a discounted entry and I didn't get it. Well, I missed it. It went without me because it went very quickly and I missed it. But if it's a daily H4, H1 level, then I want a higher time frame set up to form. I'm not going to look for M5, FB, or for daily level. I'm going to be looking for H1, H4. Because this is, it's a daily H4, H1 SR, M30 SR. So I'm going to look in first and foremost for the FB to form around those timeframes. I'm not going to watch it on M1 for a pure M1 FB in isolation because it's obviously not likely to occur anyway. I can look for that higher time frame set up to form first before then potentially if I want to zoom in and use some fancy stuff to find advanced entries which don't work in that occasion. I've not found that. I've used FX Pro for this just because, for no particular reason. I've got lots of brokers and lots of demos and lots of live accounts across different things. I've never found. And obviously I have people that do use different brokers. I've had people use IBFX. I've people that have used Admiral, and they've all got different H4 closes. And I've never found anyone suffer because of a different time frame close or showing results that have suggested that it's because of their broker's close. I think it's all a bit of a muchness, and timeframes are a much of a muchness. I mean, we only use what MT4 gives us, but why do we use H1? What about this is something a bit more advanced? But again, it comes down to mindset as well. Like, I don't necessarily just look for H1. If H1 doesn't close in the right way, I don't just leave it and look away. I'll look for H1 10 minutes, for example. What significance does H1 have over H1 10? Because it's all about the order flow. It's not about the bar itself. It's about the actual what's happening behind the bar. Something for a different webinar maybe, but I don't necessarily just look for H1, H4. Well, I mean, I hate MT4 because it doesn't give many time frames, and it's hard to, you have to visualize it yourself. But so I don't think there's much of a difference between. So I don't think there's much. I think there's much of a muchness between different brokers, different feeds. In terms, I think daily close is more important because I think more people look at the daily time frame than other time frames and look at a daily close. But in terms of H4s, obviously that's the only time frame because H1s are all the same, etc. Everything else is a multiple. But H4s, I've not found myself, and anyone who I've worked with has shown different results through different H4 closes. And like I said, I myself don't necessarily just trade H1. I will trade a H1 10-minute FB if it tells me the same thing as a H1 for the most part. Now, there are some significances of H1 close in terms of what people react on certain bar closes than a H1 10-minute, but for the most part, you're looking at the order flow behind the bar, not the bar itself, essentially. So it's more about what that's telling you. Does it tell you something 10 minutes after the H1 close? Then I'm not going to prejudice it just because it's not a H1 close necessarily. But that's more about a mindset thing, I think, than anything else. Yeah, I mean, this is the first false breakout. It's M30, obviously, but if you're looking at M15, it's a 2-bar rejection, which you know is an M30 bar. You can see it clearly on an M15, the rejection down. I mean, this is actually better to look at in a way because then you're seeing the strong breakout, you're seeing the breakout rush, and you're seeing how that was reversed in terms of the strength of that reversal and from a distance. And it's logical to expect. You wouldn't expect price to come down after that type of rejection. There's nothing in here, so you wouldn't expect price to do anything but go up. Especially when you see that momentum, and then you combine it with FB order flow. You would be shocked if it went straight down after that. Yes, Hagen, that's my favourite 48-minute. But you can get tools to merge time. I mean, MT4's crap for that. It's rubbish for your time frames and merging time frames and stuff. So you have to have a good mind in terms of being able to visually see things. But don't get too hung up about H1, H4, M30 because there shouldn't be placed as much emphasis as it is on those bar closes. But that's a bit more advanced, take things slowly. There's plenty of setups on H1 and M15 and then H4 and daily without thinking about H1 1 minute, H1 2 minute, etc. But it's more about the areas. You're looking for the areas and you're looking for the order flow that occurs. Time frames is just a secondary to that because that's what we have available to us. If we had H2, H3 closes in all our brokers, we would look at it just because it shows it to us. But it's all about looking at the locations where you expect that order concentration and looking for the order flow to be occurring. That's what you're looking at. You're not necessarily looking at time frames. That's why I don't really care whether it's an M5 setup or daily setup. I'm not going to place more risk because it's a daily setup compared to an M5 setup. I prefer an M5 setup because I can get a winner quicker. So it's going to take me the next 10 minutes to get a winner than it is going to take me the next day to get a winner. That's how I look at it. Yeah, that's pretty much it, Freeze. I mean, I'm not a fan of patterns. Anyone that's in my trading room or been a member for a while will know I have a big disdain for patterns and the way people look at patterns. Patterns are just a visual representation of something that's happening behind the bars. Most people don't understand what's happening behind the bars and they just look for the visual representation without having a clue what's actually going on behind, and therefore you lead to things like you get things like H&S patterns, which you'll give to 10 traders in retail and you'll get 10 different answers. Because no one really knows what's actually happening in the H&S pattern, therefore they don't know what to look for. Therefore, they use subjective reasoning rather than objective reasoning, looking at the way bar forms rather than looking at what's happening behind the bar. Okay, let me just finish. I've got just a few more to go through. Aussie dollars, a couple of setups here. I marked one, but there's another one. Supply, swing high. This is M15. Clear false breakout, and it's hitting supply. It's material false breakout in terms of you had the what's called a liquidity spike, the spike up, instant reverse as it hits supply, close below there. And then this is another example. You've got the close support resistance. You have to weigh up. You're hitting to clear supply. It's a very strong rejection from supply in its own right, and it's a false breakout and a material false breakout. Is that likely to be strong enough to push through that very close support resistance? Now, it's obvious to say yes because it did, but you should be able to conclude that, yeah, it is. And this is a bit of a choppy area. It's a bit compressed down there, but I won't go into that. And we have an SR flip within amongst this chop down here as the FLS. And then we have another one, second time back to the same supply. Move that up. Another swing high. Same thing, extremely strong rejection. If you look at the size of the total rejection, extremely strong, and it's coming from supply, so we know it's institutional supply, it's a proper rejection. And again, it comes down to the same. You see supply, demand within there, and it comes down to the same area. Now, when we had this one, for example, another example, the bar closes down here. Didn't draw that very well, but I certainly wouldn't expect it to be coming back up here again, especially when you've got the, it's so far away from the SR. At most, I'd expect it to do that. But because it's closed so low and you've got a little bit of symmetry, which I'm sure if you zoomed in you'd see it in a bit more detail, you've got kind of that, you've got that supply up there, which acts as demand on the way down, which has acted as supply on the way up. I wouldn't expect it to go much higher than that SR, so I would be looking for a tighter stop in a scenario like that. Pound dollar, H1. Again, an impulsive move down, tiny false breakout. It's not going to be interested in that. There's nothing there that tells me either way. It's 50-50. Is that demand consumption? Is it a true false breakout? It's just, there's too many question marks over that. And if you were in it, there'd be reason to cut it. This is one of the ones where, I said silver worked out, but if I was trading that silver, I wouldn't have been in this down to there. If I was trading that, I would have cut half my exposure. I mean, obviously it happened overnight, and I don't hold trades overnight. So, but ignoring that, for example, and the fact that we would have expected it to be slow because it was pre-Asia, New York closed, pre-Asia into Asia. Ignoring that, if this was just like, London and New York time, I wouldn't be holding all of this down to there. I would have cut half around here. I mean, it rejects off there, so I'd be looking for it to go after that, and it does go, but then it does nothing. So I'd be cutting half of that. That's one of the ones where I would be cutting it, half of it, because that's, we've seen over all of these examples, none of them have done that. So the same happens here if I was in this, which I wouldn't be. But after the rejection of the SR here, you'd expect it to go there because you've hit the demand of the SR again. It should go now, and it comes straight back down. So if I was in this and my stop loss was below there, I would be cutting half of it down here, because that's not how you expect it. We've been over a lot of examples here. None of them have done that and worked out. None of them have acted like that. Let me just do the last one then and go back to Q&A. M5, euro dollar. This last one, yeah. Euro dollar. Swing low. Horrible price action to the left there, but swing low. Again, material. This is 10-minute bar. I get a lot of 10-minute bars when I look at intraday trading. It's annoying to have a 10-minute chart, but you don't need it really. I mean, M5. Obviously, this is a very big false breakout, and it stands out. If you look at these two bars compared to all of this sideways moving, these completely stand out in terms of that's the breakout rush. It's been completely strongly rejected. It's hit. There's new demand that's come in here, and there's obviously a clear SR flip along here. Okay, so that's all the examples. Hopefully that's enough variation of examples to give you guys a bit more of a feel for what I look for, how I look to trade them, and how they can apply across. Obviously I deliberately picked various pairs and found what a sell up per pair across a variety of different time frames, mostly higher time frame, like H1, H4, I mean by that. Yeah, candles like bullish outside bars and that, no, I'm not going to go into it now because it's a rant and it's a whole webinar, and my trading room will know what I mean. But no, I don't look at things like bullish outside, not in this traditional context anyway. I don't look at a bullish outside bar and go, oh, I don't look at an area and say, I'm only looking for a pin bar, bullish outside bar, or a certain type of bar to form. Because that's not price action. That's not being objective. That's being subjective, and that's retail. That's not professional price action, in my opinion. So no, I look at different things, which is beyond this webinar. But no, I don't look at patterns in that way, and I don't look at bar types and things like that. I'm always looking at what's happening behind the bar in terms of order flow, in terms of market participants, in terms of supply, demand, rejection, consumption, and those type of characteristics. Bars are just a graphical representation of that, but without knowing what's behind the bars, you always rely on subjective analysis and just wishy-washy analysis, really. That's why retail struggle with price action, and that's why you give a certain setup to 10 different people and you'll get different answers. When things like false breakout is objective and it's logical, you know exactly why it works and how price should move, and should give, bearing in mind different risk tolerances, but you should give a setup to the same 10 different experienced people and should get the same kind of answers. That's what objective type trading brings out. Grizzly, can I ask a silly question on the Aussie dollar chart? Yep, go on. You wouldn't have considered this supply. Well, supply is just somewhere where price fell down from, isn't it? So if I'm looking, okay, the first one was above here, wasn't it? Then this whole area is supply, because you've got decision point along here, and you can see, well, you can't probably see it that closely, but you can see there's, so you can't see it that closely, I said you can see, but yeah, there is an SR flip along there, and you can see it along there, so there is a decision point there. So that's how I'd be marking up the whole SR supply zone. But you can see price actually reacted within the source of the supply. Price broke demand within here, it dropped down. It found supply within here, dropped down. So the whole zone is along here. But now we've had the first touch here. That's the FTB to it. Now we've had a deep touch. Then obviously first, second, third, fourth touch. Then we've had some news. Clearly, we've cleared it, come back down, found demand, new buyers, and break out higher. But yeah, I mean, obviously the more obvious the ones, the easier it is. I mean, I only mark up the more obvious ones as well when I'm looking at scenarios. I'm looking at clear supply and demands that haven't been tested yet, that price is going to drop or rise into. This one's slightly different. It's already hit the supply, so it's the second time back to it. I'm more looking for ones like this. You've got a clear RBR there that hasn't been hit yet. So it's the first time back to it, which is also a good thing rather than being the fourth time back to it. Yeah, I mean, trading evolves in terms of, I used to use Fibonacci. I don't use any indicators or anything like Fibonacci. I still think fibs work. I think they're self-fulfilling in a way. I think in terms of confluence, but I just don't trade like that. My trading's moved on and evolved and adapted over times. I used to use confluence a lot. I used to use trend lines a lot more than I do now, but I've gone off trend lines. But your trading evolves. I mean, it goes around the same concepts, but it's just the way you apply it changes. So I did used to use confluence, 50, 61% fib confluence with SRs, trend lines, etc. And they do work because I made money doing it. But it kind of, I don't know, as a trader, you adapt and you evolve over time, and your personality changes slightly as well, and what you look for and how you look to trade. And the market does change over time as well. I made most of my money during what I consider an easy market in terms of when there was a lot of risk aversion going on. And it was very easy because there was a lot of fear in the market, so you got a lot of big moves. And the market isn't like that anymore. Volatility is extremely low relative. Hence a lot of my trading. I mean, I never used to trade M5, M1, M15, but I've had to adapt and go where the volatility is. And if I waited H1, H4 for setups every day, I wouldn't get that many. And because there isn't that many, that gives me the time, and I still like H1, H4, and M30 and around those timeframes, H2, H3, etc. And I have a whole profile where I just look for H1, H1. I keep those separate to my intraday trading, where because I don't get that many setups on those anymore, I look at M5, M15 a lot more to build up for the fact that the volatilities in FX has decreased significantly over the last 24 months, and particularly over the last 12 months. But like things like MACD Grizzly, I mean, when you become more experienced, you understand what divergence is and how to spot it. Divergence is essentially distribution and accumulation. And you can spot that on a chart without using an indicator to show you that. There's nothing wrong with using an indicator to show you something, but when you become more experienced, you get to know that actually you don't need it and you can spot it on by price alone. Divergence is just showing you a slowdown in price and likely accumulation distribution. I mean, I used to use divergence. I used to use RSI, and I used to use RSI for divergence as confluence to a setup. But then I learned over time, you move away from the retail way of learning things and think more objectively and looking at price alone. So I don't use any indicators and any fibs or anything like that. In terms of like the number of setups and that, one of the future webinars is like end of the month is doing a monthly review. So I'll go through all of January and find the number of setups. Now, I'm not going to go on M5 throughout the whole of January and over every pair. I'm going to concentrate more on H1, H4s, and obviously most people are trading more those timeframes than M5 because not everyone's a full-time trader, etc. So most people I work with tend to trade H1, H4 daily or M30 or occasionally get time to trade the lower time frame stuff. I mean, obviously I do have some full-time traders as well, but if you're not a full-time trader, you can't watch M5 all day, obviously. So most of my stuff does focus around those higher time frames with the occasional looking down at some lower time frames just to show you that it does work equally as well on any time frame. Not really. At 9:30 at night, not really. No, honestly, volatility was extremely high during the financial crisis, and obviously it's not going to stay that high because that was a black swan event essentially over the whole period. Why is it so low now? I don't know. Don't ask me hard questions. I don't know, but it has. And people don't trade FX as much as they used to as well, but I don't know why, but all I know is that I noticed it because I trade M5 where I never used to trade M5 2 years ago. It could be a mixture of certain things. You think about central banks, you think about interest rates all being low, who's controlling the market at the moment, and things like that. I mean, you can come up with a whole wealth of reasons, I think. Let me look, Rob. Euro, dollar, euro, yen even. It has been a long day. You mean this one here? Yeah, I mean, it's kind of M5, 10, 15, isn't it? But not when it's showing M15, I doubt, no. You can see prices here, clear demand here. That's a very nice demand, potential FTB there. And we've had the rejection. I mean, obviously the time of this is not something I would trade because of the time of day. You're coming into New York close now. You don't expect good momentum. I'm not seeing watching my charts. It's the time of day when I'm reviewing, preparing for the next day, normally. So we've had the strong rejection. We move back above this previous swing, which also has SR history, so it's a swing straight SR. But you've got to look at that supply within there really, especially at this time of day. Hasn't exactly behaved, in my opinion, in terms of after this bar here. I would have looked for a quicker move up than what it did, but time of day, you've got to bear that into account if you're trading this, which I wouldn't be at this time of day. There's a time to be trading and there's a time to be relaxing, in my opinion. So yeah, but this has the hallmarks of a setup. It's very clear demand, clear SR, swing low, great rejection. It's a material force breakout as well. It's a close supply. You might be able to get value up to there. In terms, just go quickly what I consider value in terms of risk reward. I don't have a minimum. Okay, no, that's wrong. I do have a minimum. But again, it's more about the setup. If it's a great setup and it's going to be like 0.7R, I will take it. Now, I do try and look for more than 1R. I am an intraday trader and I'm a momentum trader, so therefore I don't run my trades very often. So I don't look for 3-4R winners unless I see a good reason to hold it, or just the FLI, if it happens to be 3-4R way, which obviously isn't that common. So I look for 0.7, 0.8Rs. I mean, I'm not going to take a 0.4R, 0.5R trade because that's just silly. I don't care what your win rate is, 0.4, 0.5R, you've got to have a very high win rate to make money doing that. So I look for like 0.7, 0.8, especially if you're looking at some of the best setups carrying ranging markets. So if you look at ranging markets, one thing that's going to be lacking is space. You're always going to have relatively close FLI, FLSs. So unless you're looking for a break of a range, you're always going to be like 1R roughly to the FLI, FLS. You're not going to get a 3R runner because you're not going to get that space. Now, if you're looking at a swing FB, you might get that space. But most of the time, most of my FBs, in terms of trading in the traditional way, this kind of way, I would be looking around an average 1R winner without taking into account any runners I might run, any ones I might run. But I am a momentum trader, so therefore I do tend to trade them to the FLI, FLS only. Get my pips, get my R, and move on. Yeah, of course. I mean, I do run trades, but I just look for certain things and certain price action that suggests it could be like a daily time frame location, a daily bias. It could be compression, things like that. Lots of things, but I look for certain things that tell me it's much more likely to run. I'm not talking about 50-50. I'm not talking about 60-40. I'm talking about more 75-25. That yes, I think it's going to run. I might cut half of it and let it run. But otherwise, I'm all out because you've got to trade as to what suits your personality, and trying to catch runners all the time and getting stopped out when it doesn't run or it comes back again, and having to make those decisions, it just does not suit me. Everyone's different, and I don't look for runners on the most part. I'm not a swing trader. I class myself as an intraday momentum trader. But then when that's up to you. You've got to figure out what your personality is, and you take the same concepts, the same material, and personalize them, develop them to suit your own style, your time frames, what you trade, and your own personality. That's a big part of learning to trade, is figuring out what suits you. $50 to 1R, yeah. We can all dream, put it that way. I think one of my biggest ever winners, actually, I did have a very big gold last year, early last year. I can't remember exactly, but I had a very big gold winner FB, which was it. Just you know what gold can do sometimes. I mean, I suffered an FTB where I got slipped on a gold when it had that big drop last year. You know what gold can do. It can act like that. But I got on the right side of it for once, and I took an M5 trade, which I didn't. It was a bit unlike me back then, and it completely went, and I got a massive runner. Apart from that, I think my biggest ever winner R-wise has probably been BOJ intervention. I got in on that at some point. So, but yeah, no, yeah, you can do. If that's obviously the best way to use M5 is to use it when you have a daily viewpoint or daily bias. I mean, again, daily bias sounds very rule-based, system-focused, but if you have a kind of bias like that and you can hold a trade, some people struggle to hold a trade. I do. Then also that's the best way to use M5 to get your big winners. M5 can be used as obviously a very good way to get a discount into a higher time frame setup. I do that, but again, I am still a momentum intraday momentum trader, so I'm not looking to run trades overnight. I forgot one thing, just quickly, very quickly. Go back to the slideshow. Yeah, no, I'm not a fan of indicators, and I'm not a fan of rules and systems. And ADR is, in my opinion, very much like leaning towards that. I don't ADRs. Well, let me explain something, because this is going to come onto this as well. Nuances. Now, obviously, as you trade, you pick up things. You spot things. Chart watching. Chart watching brings experience, which brings things where you notice things that you don't notice and you don't read in a textbook. Okay. And obviously, every pair does trade differently. Every asset class trades slightly differently. The same concepts work because it's all based on order flow, which is all based on market participants, which essentially is based on herd mentality, and that exists across the board. It doesn't matter what asset class you trade, as long as it's liquid enough, you're going to have that order concentration. Okay. Now, but within that, you do have certain pairs that behave slightly differently. When you notice things, you pick up things. Like dollar CAD. Someone said dollar CAD is crap to trade. Yeah, it doesn't trend. It ranges. Therefore, it's great for FBs. It's rubbish for FTBs because it doesn't break out very often. It doesn't have that strong momentum moves, but it does range. Therefore, you do get a lot of mean reversion, i.e. the elastic band effect. Once it does move fast, it normally snaps back, like that trade, that setup showed earlier. And so within certain asset classes, especially FX, when obviously there's lots of different pairs, you do get certain things where you pick up things. Now, there's not a ton of things, but there's certain things that over time you pick up, and you can note that when you come to looking at setups. So, for example, as I said, some asset classes are more mean reverting. Okay, an obvious one is the metals, gold and silver, and oil. I hate trading oil. I was slightly better recently, actually. I started trading it slightly differently, but traditionally I used to trade FTBs a lot on oil, and just don't make money doing that. But oils and metals, I mean, anyone that trades, as I said, like last year, the gold FTB, where everyone got slipped on it because it was at the actual pit open, exchange open, it obviously it tumbled a lot. Gold and metals are very much like that. They'll go through periods they're not doing much, then all of a sudden you get impulsive moves out of nowhere. But within intraday swings, intraday moves, those impulsive moves have a mean reversion nature to them, i.e. they have that elastic band in terms of they retrace very quickly, not the whole extent. But when you have a swing FB against an impulsive move in a metal, it's much more likely to work out than it is, say, on euro dollar. Now that's something you can find out for yourself. Just go over H1M30 on silver, metal, crude oil, and compare it to euro dollar, euro yen, etc. Or and you'll notice it straight away. Go over 6 months worth of history and you'll notice. Now I notice that from forward thing because obviously I've been trading for a long time, so you pick up things and you note them down. You mentally pick up things. Intuition comes into play, etc. But certain pairs and asset classes are much more mean reverting in terms of mean reversion against impulsive swings intraday, and the metals and oil and dollar CAD and dollar yen are the four things I would say are very mean reverting, and therefore they are ones where I am more likely to play or be less picky on an impulsive move compared to how I've discussed it here, because I know they have a higher chance of working out because I've seen it over time. Okay. Now, coming on to ATR and ADE in terms of average daily range and stuff, no, I don't look at that because I don't think you need to be that kind of system approach with it. Kind of everyone knows who's been trading for a long time that after strong trending days that are unusual, you are much more likely to get a retracement come after European close and towards New York close, i.e. New York PM. If you're going to get retracement, it's going to happen then. And if you've had a big trending day, you are more likely to get a retracement, either that little snap back, that profit taking at the end of the day, than you are on a low ranging day. It doesn't mean using ATR is wrong, but I don't like that kind of approach, that putting a fixed number on things, or if it's above there, therefore it's more likely to come back. I can do that visually, because I know when we've had a big day in equity markets, because you can see the moves for yourself. I just don't think you need to put a number on. I think you pick up more things more if you look at intuition and just look at things visually and using a bit more logic about it rather than just looking for a fixed number. Oh, it's 2 past its ATR, therefore I'm going to look for, I just don't think market works like that. It doesn't mean it's a wrong way of doing it, but I just, it's not the way I look at things. I'll never use an indicator for measuring things like that. Okay, just wrapping up now, so final questions. I use a mixture of spread betting and ECNs. Spread betting is much better than what it used to be, hell of a lot better. Straight market makers, yeah, you still get problems with some and stuff, and I'm having a problem with one of mine at the moment in terms of their platform and feed keeps freezing on me. But yeah, I think for smaller accounts, spread betting's good. Yeah, tax-free element of it, I think that's hyped up a bit too much, to be honest. It's not the be-all and end-all. You have to be making money first to care about that. And I think you obviously get better spreads elsewhere than any spread betting firm will ever give you overall, especially if you're trading forex and you're trading a range of forex pairs. Like if you're trading one pair, it's slightly different. But if you're trading like I do, a range of majors, crosses, especially on the crosses, you'll find spread betting firms are generally very poor on the crosses. The less liquid it gets, then they're good for the main indices. You get your 1 pip spreads on DAX, CAC, FTSE, etc. And you get euro dollar, Aussie dollar, and euro pound and dollar yen very good. But as soon as you start going like, I don't know, pound CAD, pound Swiss franc, you're going to get much higher spreads. And then most of my trading, well, a high percentage of my trading is much more lower time frame, 5-15 minute than it used to be. So therefore spread is a high cost of my trade, and therefore you can do a calculation, you can do a rough calculation in terms of what's the advantage of tax saving compared to the better spreads you're getting elsewhere. And well, I think it's people are over egg with tax saving myself. But yeah, I do use a mixture of spread betting firms. FXCM being one of them is my new favourite spread betting firm, but only for small accounts. I wouldn't ever use them for larger accounts. I used to use Oanda, as some people know, but I've stopped using them. They've pissed me off a bit too much recently, so I've actually stopped using them completely now and moved to LMAX, which I like. But yeah, I tend to use a variety of different brokers. It's better to split your money in this day and age amongst different brokers, and potentially for me, FSA regulated brokers, when you get that compensation scheme as well, and just fund as much as you need to fund. Leverage is a good thing in that respect. Well, I use LMAX, which Armada are an IB. They use LMAX as a liquidity provider, but so it's very similar spreads and commissions, but obviously LMAX is FSA regulated and Armada is Estonia. So no offense to anyone in Estonia, but I'd rather use an FSA regulated broker which has the 50 grand compensation than a broker. But yeah, Estonia use LMAX as one of their main liquidity providers. So they're much of a muchness. Are you getting the same type of trading conditions? Yeah, and I've heard good things about them. How should I back test FTBFs? Just go, yeah, just pick a time frame. I mean, it depends obviously what time frames you trade. Don't pick M5 if you trade H1. That's pretty common sense. And pick a variety of pairs or asset classes that you are interested or you are trading, and pick a time period, say 6 months, a year. I mean, it's boring, it's tedious, but that's what you need to do if you want to make it. If you want to get confident with your trading strategy, then you have to go and back test it. You have to go and build that library of setups. I've done it myself. Other people I've mentored have done it. You have to go back and build hundreds of setups, because you watch something 100 times, you're going to get confident. You're going to know exactly what to look for. You've got that intuition. You've got that 100% confidence, and you have to stand a much better chance of going out and trading it. But a lot of people don't do that. They don't have. It's tedious doing it. It's boring. It involves spending time chart watching at weekends or things like that. But the first stage in learning anything is go and find a ton of setups so you know what to spot for. So you can look at a setup straight away and analyze it. And the next step is obviously trying to trade it going forward in real market conditions, which is obviously a different task. Yeah, I mean, what I do is just I mean I do it at the end of each year. I haven't done it for the last part of 2012 yet, but I pick a variety of times. Yeah, I'm not going to go on M5 over a 6-month period. That's just silly. You know, I wouldn't be trading because it would take me 6 months to do it. But I'm going to take M30, H1, H4 across a variety of different pairs because I trade a lot of different pairs, so it makes sense to do that. And I'm just going to go and save setups, different types of setups, ones that did and ones that didn't work. It's important to get the ones that didn't work and figure out whether it was just a losing trade or whether you're spotting a repeating pattern. For example, the impulsive moves in small FBs. If you find they do work, then obviously I've done something wrong. But see what I mean? You've got to build up that library of setups across different pairs that you're going to trade, different time frames, and different nuances of each one. Like, you know, obviously some of them are SR with SD zones, some of them are swings, for example, and things like that. But it's important to spot the ones that do work, how they behave, where does price move to, how does it move? And you build up that by looking at loads of setups in terms of you build up a lot of intuition. I'm a big fan of intuition in trading in terms of the more you look at things, the more you think of, you analyze things, it becomes second nature to you rather than having to go through, you know, an actual checklist all the time. Trading should be based on intuition in terms of you should be able to look at something and know straight away whether it's a tradable setup for you rather than have to go through a list of rules or a list of, you know, points to tick off. That's what a fully confident trader does. LB, what do you mean small account, medium account, big account? Any ideas what pro traders, I mean, in terms of size, what's deemed a small account, medium account, or large account? That would just depend. I mean, a small account, like a large account for me, a small account for me in the UK could be a large account for someone living in a country that the cost of living is very low. For me, what would be a small, medium, and large account? Large account's 100 grand plus probably. Medium account's probably 50 grand. The small account is 10 grand and under. I would never trade a 100 grand account with a spread betting firm. That's my personal opinion. I don't trust market makers that much. Yeah, I mean, ECN doesn't have that same conflict of interest. That's why LMAX they're slightly different because they're an actual market where it's hard to explain. But yeah, LMAX aren't, all intents and purposes, the same as the ECN. You don't have, they're passing through orders and taking a commission rather than actually creating a market for you and seeing exactly where your entry stops. The thing is now spread betting is much better than what it used to be, definitely. But yeah, I still know people that suddenly they become profitable in trading big size and suddenly they get requotes, trade delays, and they moan to the broker, and then all of a sudden it's rectified again. There still does exist in the spread betting or market making. Most spread bettors are market makers, but yeah. I mean, most of my market maker accounts are all of them are sub 50 grand. Because I do split my money between different fees because I trade different brokers with different instruments. But I would never put more than 50 grand. I mean, everyone saw what happened with world spreads if you're UK based. I used to have a world spreads account, not for long, and not when it went down, thankfully. But yeah. Okay. I hope that's been useful. I said I'm doing a series of free ones, so I can't remember the schedule now. I think it's FTBs next week, and then we do a wrap up. But you know, I just do follow up webinars as and when I think things are interesting. I get questions and stuff. But yeah, I hope that's clarified a few points and helped to just show a bit more insight into how I look at FBs and the concepts behind it. Okay, as I said, I have recorded it with Camtasia and Omnovia, so hopefully one of them will work. And I'll send an email around through the mailing list. It'll probably be a few days before I get it up somewhere. Okay, take it easy, guys.